Welcome to the market update. Today is Sunday, March 23rd, 2025, and this is your instructor, Scott C. Let's start off by talking about what the market did last Friday. You had the Dow dropping 400 points, and then from there, swings started as the indices started to rise. Around 1 p.m. Eastern Time, they touched the zero line. The S&P crossed up first, and then they all put on the brakes, going flat until the rise in the last 10 minutes. Now, it's hard not to blame recent political decisions for the volatility. Federal employment cutbacks, interest rate decisions, tariffs, and conflicts between governments has set the market on edge. I'd like to specifically point out Tesla and how Musk's involvement with Trump has put Tesla in a free fall since the start of the year, with sales slipping and all sorts of protests. Its stock actually rose today after Musk's meeting last night with employees. I want to focus on the chart of the SPY. This is basically your general market, and you can see that we've been in a good uptrend all the way here until mid-February. Then it's just been down, down, down. We got a little bit of a bump, and let's specifically focus on Monday. I'm going to zoom in on the last week, and we're going to talk about each day and what happened and what might have been a factor for some of this volatility. So I'm going to just zoom in here to the last little bit so you can see it easier. So the market's advanced pretty good, with stocks posting solid gains as investors embraced risk assets. So basically, when investors start moving into risk assets like cryptocurrency and tech stocks, they're feeling pretty good about the market. So this upbeat performance came despite economic indicators sending conflicting signals. We had a weaker than anticipated retail sales growth, which was 0.2%, and a surprisingly poor New York Fed manufacturing reading that tumbled to -20. So basically, with risk-on sentiment, people moving into tech stocks and more risky investments, that hurt the dollar, and the dollar itself declined against most currencies. Now, there's a lot of geopolitical tensions, and that hurt energy as crude oil prices rose following the American strikes on the Houthi targets in Yemen. On Tuesday, all the market indices retreated, with stocks closing firmly in the red as weakness in communications, tech, and consumer discretionary sectors weighed on the performance. There was a strong demand for the Treasury's 20-year bond auction, which made those fixed income markets going higher. Tuesday's economic indicators painted a mixed picture, with import and export prices coming in above forecasts, housing metrics showing strength, and industrial production outperforming expectations, leading the Atlanta Fed to revise its GDP outlook to -1.8% from the previous -2.1%. And if you'll recall that Tuesday was the day that Presidents Trump and Putin had discussions, and they'd agreed to implement a 30-day moratorium on attacks targeting Ukraine's energy and infrastructure. So they ended up stopping short of a full ceasefire agreement. President Zelensky actually voiced support for the arrangement, and I think the market was really now kind of focused on what's the central bank going to do with the Federal Reserve meeting tomorrow on Wednesday. They were expected to maintain the current interest rates. So on Wednesday, stocks rallied after the Federal Reserve's decision to keep its benchmark interest rate unchanged at the 4.25 to 4.5%. Also, as they announced a slowdown in its balance sheet reduction program starting next month. So, yep, you can see that the markets all went higher across the board. But the Fed's move to hold rates steady really kind of aligned with the market expectations. I think investors were encouraged by plans to reduce the monthly Treasury redemption cap from $25 billion to $5 billion. Fed Chair Powell adopted a cautious tone during his press conference, emphasizing that central bank is not in a hurry to adjust rates given various economic uncertainties. So the Fed's interest rate projections remained steady, still indicating 2 potential rate cuts for 2025. The market was also looking at a reported phone conversation between Presidents Trump and Zelensky about the Ukraine situation. So Thursday, all the major indexes finished lower after really what was a pretty volatile session in what traders actually dubbed Super Central Bank Thursday. Energy stocks actually led gainers with about almost a 0.5% rise as oil prices climbed following new U.S. sanctions targeting Iranian oil shipments and related entities. So one thing to note about Thursday is that there were some decisions from multiple central banks, with Switzerland cutting rates while the UK and Sweden held steady. Turkey made headlines with an emergency rate hike to 46% to defend its currency. And then on Friday, you can see that everything really kind of opened up way down. So all the indices had gapped down, but that's where everything started going back up. At around 1, we recovered, and we actually closed much higher for the day, which was good. It was encouraging. I like to use the QQQ as my canary in the coal mine. I know they say that a lot, but it really works well if we're on a 2-week chart, 30-minute time frame. So you can see that there's 14-day, 30-minute time frame, and I've got 2 indicators, the 10-period simple moving average and the 50-period simple moving average. And I look at just how they interact with each other. If the 10's above the 50, I'm bullish. 10 below the 50, I'm bearish. Right now, kind of taking a cautiously bearish approach, but if you look really close with the close that we had on Friday, that 10 is just starting to cross the 50. We're getting a buy signal. So this week should be kind of interesting. So let's talk about what's next. I'm going to take you into the Forex Factory calendar, and we're going to focus just on the USD. We've got the Flash Manufacturing PMI and the Flash Services PMI coming up here tomorrow, Monday. We've got an FOMC member speaking. In fact, we've got 2 FOMC members speaking. Now, if you're not sure what some of these things are, like the Flash Manufacturing PMI, for example, go over here and click on this little folder, and it talks a little bit about what we're looking at here. And the interesting part right here is why traders care. It's a leading indicator of economic health. Businesses react quickly to market conditions, and their purchasing managers hold perhaps the most current and relevant insight into the company's view of the economy. So we're going to close that. Let's take a look at Tuesday, and we've got some new home sales. We've got some consumer confidence. Now, I don't really care too much about that. It says right here orange, which is a medium impact expected. Personally, I rate that as yellow. So we've got a higher impact expected on those Flash Manufacturing and Flash Services announcements on Monday. So Tuesday, there's really nothing that is likely to cause a lot of volatility in the market other than, hey, we're living in some uncertain times with a lot of changes, and naturally something could come along that sparks a lot of volatility on Tuesday just out of the blue. But according to the Forex Factory calendar, we don't see anything that we should really put on the map as making the market really volatile. On Wednesday, we've got some core durable goods orders. Again, nothing that's likely to cause the market to move huge. On Thursday, we've got some GDP news, quarter over quarter, and unemployment claims. And then finally, on Friday, we have the core PCE price index. We're going to click on this folder over here, Why Traders Care. It's the Federal Reserve's primary inflation measure. Inflation is huge. It's important to currency valuation because rising prices lead the central bank to raise interest rates out of respect for their inflation containment mandate. So inflation data coming out on Friday that could cause the market to be a little extra volatile. And as of right now, the real-time stock indice futures has everything up. So according to the futures, tomorrow is looking to be a decent day. When you go back and look at the overall chart of the market itself, we've already kind of fallen pretty hard. We've broken down below the 200-day moving average. Broken support becomes new resistance. So I'm putting my cursor right here where we should have had some support. We're going to call it about 580 on the SPY. So if we make our way back up to that level, watch out, we could find some resistance. So old support becomes new resistance. The fact that we broke down below the 200-day moving average, not a good sign. So right now, maybe we're looking for a little bit of a bounce back up in the market, but we're going to play very defensively and be very cautious. At this point, we're looking at potential lower highs and lower lows. Now I'm going to go back just a bit here, and we're going to look at a 3-year weekly chart. So when you take a look at the big picture, the overall longer-term trend is still up, but this is a pretty hard fall. You can see that there's some old resistance right here. Old resistance becomes new support, so I think we're at a very interesting pivotal level. Basically, my very short-term indicator, the Qs, are giving us a buy signal for a short-term bounce. The 1-year chart is overextended to the downside, so we might get a little bit of a bounce, but that 1-year chart was not looking good. When we look at the 5-year chart, the 3-year weekly chart, we see some good signs. We've fallen down far enough, sitting at a potential support level. So let's keep an eye on things, but tighten those stop losses up. Be cautious. They say to buy when there's blood in the street, but you don't want to catch a falling knife either. So right now, caution is the name of the game. So take this information, go out there, and don't be haunted by the markets.